Good day, everyone. Today's video is going to be a little bit different. In this one, I'm going to walk you through all the trades I took in the month of April, so you can see not just the results, but also the thought process behind every trade. Now, I'll be honest with you, the month of April wasn't the best in terms of price action. The market wasn't as clean as it usually is, and that's largely due to everything happening globally right now, which naturally creates more uncertainty in the Forex market. So overall, I took a total of 7 trades in April. Out of those 7 trades, I had 4 losses and 3 wins. And in this video, I'm going to break down each trade individually so you can understand exactly what I saw and why I took those trades. Now let's go through them quickly. The first trade was on NZDUSD. That was a minus 1% loss. The second trade was on AUDUSD, also a minus 1%. The third trade was on EURUSD, another minus 1% loss. Now let me pause here for a second, because this is where a lot of traders make a mistake. After 3 losses in a row, most traders would go back to their charts, start questioning their strategy, start tweaking things unnecessarily, even when they already know the strategy works. And what does that lead to? More inconsistency, more losses, and a cycle of self-sabotage, over and over and over again. But for me, it's different. I already know my strategy works. I've tested it. I trust it. So 3 losses? That's nothing. In the grand scheme of things, it doesn't mean anything. Now moving on, the fourth trade was on GBPUSD, and that was a plus 2% win. After that, I took another trade on NZDUSD, which was a minus 1% loss. Then I had a trade on AUDUSD, which gave me plus 2%. And finally, my last trade of the month was on GBPUSD, which closed at plus 1%. So at the end of the month, my total P&L was plus 1% profit. Now here's the interesting part. Even though I had more losses than wins, I still ended the month profitable. And this is where a lot of people don't understand the game. This is the power of risk to reward. You had 4 losses equals minus 4%, but then 2 wins at plus 2% each equals plus 4%. Now you're back at break even. And then the final plus 1% trade, that's your profit. This is how the Forex market works. It's not about winning every trade. It's about understanding probabilities. There will be good months, and there will be slower months. For example, in March, I made plus 9%. In April, I made plus 1%. That doesn't mean something is wrong. It simply means not every month will be the same. So don't expect consistency in outcomes. Expect consistency in execution. Now let's go to the charts and break down each trade one by one so you can see the reasoning behind both the wins and the losses. And more importantly, you'll start to notice something. Each trade may look slightly different, but the underlying idea is the same. Because at the end of the day, this is a game of probabilities. All right, so this is the first trade I took for the month of April. I took this trade on the 6th of April, 2026. Now let's break this down step by step. First of all, if you look at price, you can clearly see that price is pushing to the downside. So we have a clear downtrend. Now with that downtrend, there's something else we can see. Price is currently inside a bearish daily internal range liquidity. So with price being inside that daily internal range liquidity, we already have a strong indication that price should continue pushing to the downside. And not just that, we also have a candle sweep. You can see here, price swept the previous candle's high and then closed below it, which is a clear sign that price is likely targeting the external range liquidity to the downside. So overall, for that day, I was bearish. Now moving down to the 4-hour time frame, we can see that there were multiple bullish fair value gaps in this area. So before taking any entries, I wanted those gaps to be mitigated first. And as you can see here, price came back and mitigated those bullish fair value gaps. So at this point, we're clear to look for bearish trades. Now moving to the 1-hour time frame, which is where I took my entry, the first thing I noticed was an SMT divergence. So here, NZDUSD was printing a lower high. But when you compare it with AUDUSD, AUDUSD actually printed a higher high. And that right there is a clear SMT divergence. So now we have daily internal range liquidity, 1-hour SMT divergence. But that's not all. If you look closely, price disrespected a bullish fair value gap and left behind a bearish fair value gap. And that gives us a balanced price range. So this entire area became my point of interest. So I took my entry from that zone. Stop loss, just above the swing high. Target, my usual 1 to 2 risk to reward. Now let's play price forward and see how this trade played out. As you can see, price tapped into our entry, moved slightly in our favor, and then completely took out our stop loss. So this trade ended in a loss. Now this is important because if you look at everything aligned for a bearish move, but the trade still failed. And this is where most traders get confused. Now if we zoom out to the daily time frame, you'll notice something important. Price was actually preparing to shift direction to the upside. So even though the setup made sense, the higher time frame intention was starting to change. And that's what led to the loss. So this is a perfect example of what I said earlier. You can do everything right and still lose the trade. Because at the end of the day, this is a game of probabilities. Now let's move on to the next trade and break that one down. All right, so now let's look at the second trade I took for the month. Now starting from the daily time frame, we had bullish internal range liquidity, which means the expectation was for price to move towards external range liquidity. But there's something important to notice here. At first glance, this might look like a bearish candle, but in reality, it wasn't. It was just as a result of a gap in price. That's why the candle looked a bit weird, which means price was already pushing to the upside. So right around this area, where my cursor is, that's where price currently is. So it's already reacting from the daily internal range liquidity. Now moving down to the 1-hour time frame, we can see that we also have a 1-hour internal range liquidity. So now, because we are bullish on the higher time frame, our focus becomes very simple. We are only looking for internal to external range moves on the intermediate time frames. So in this case, we are expecting price to move from the 1-hour internal range to the 1-hour external range liquidity. Now dropping down to the 15-minute time frame, which is where I took my entry, the first thing I noticed was a sweep of liquidity right after price entered the 1-hour internal range liquidity. After that, price pushed up and formed a bullish fair value gap. And that right there was my entry. So once that bullish fair value gap was formed, that's where I took my trade. Stop loss at the swing low. Target, my usual 1 to 2 risk to reward. Very simple, very clean, and very repeatable. Now let's play price forward and see how this trade played out. As you can see here, price came into the setup, and then immediately we got stopped out. But here's the interesting part. Right after stopping us out, price went straight to our take profit level. So what does this tell us? It tells us that the analysis was actually correct, but we were simply taken out of the trade early before the real move began. And this happens more often than people think. This is the market doing what it does best, taking liquidity before delivering the move. So again, this is another example showing you that you can be right and still lose the trade. And that's why consistency is not about individual trades. It's about your overall execution over time. Now let's move on to the next trade and break that one down as well. This was my third loss in a row. So let's break it down and look at the thought process behind this one. Now for this trade, I'm mainly using candle analysis for my bias. First of all, we had price close above the previous candle's high, and what that tells me is simple. The next draw on liquidity becomes the previous daily high, which means we are only looking for bullish trades. Now moving to the 4-hour time frame, we can see something very clear. Price is sitting inside a bullish internal range liquidity. So now we have bullish higher time frame bias, price inside internal range liquidity, and when you look at the target, the high we're expecting price to take also aligns with the 4-hour external range liquidity. So everything is pointing towards one thing. Price should move from internal range to external range liquidity. Now here's another confirmation. After price tapped into that internal range liquidity, we saw a sweep of the previous candle's low, which again supports the idea that price is likely to continue higher. Now moving to the 15-minute time frame, which is my entry time frame, the first thing I noticed was an SMT divergence. So here a lower low, but when compare it with GBPUSD, instead of a lower low, price created a higher low, and that gives us our SMT divergence. Now after that, price left behind a bullish fair value gap, and that is my entry. So execution was simple. Entry inside the fair value gap, stop loss just below the swing low, target a 1 to 2 risk to reward. Now let's play price forward and see what happened. As you can see, price took a bit more time this time. It came into the setup and then took out our stop loss. But look at what happened next. Immediately after stopping us out, price pushed straight to our take profit level. So again, another situation where the analysis was correct, but the entry didn't hold. And this is something you need to understand as a trader. This happens. Sometimes you get taken out of the market before the move actually plays out. And that's part of the game. That's part of probabilities. Now the key here is this. You don't immediately start changing your strategy. You reevaluate, and if there's nothing clearly wrong, you move on to the next trade. Now let's move on to the fourth trade of the month, which was actually our first winning trade. All right, so now this is the fourth trade of the month. And this was my first winning trade. Now let's break down the analysis behind this one. First of all, you can see that we had a bearish internal range liquidity sitting just below price, which immediately tells me one thing: price is likely going to move towards that level. Now, one of the reasons I had strong confidence in this setup was because at the current price, we were sweeping buy-side liquidity. And not just that, we were also sweeping the previous candle's high, which you can clearly see here. Now, when I moved down to the 4-hour time frame, I noticed something else. The candle that swept liquidity left behind a wick, and that wick is important because it shows rejection and reinforces the idea that price is likely to move lower. Now there's more. If you look just below price, you'll notice that the daily fair value gap also has an overlapping 4-hour fair value gap. So now we have a clear area where price is likely to be drawn into. Now moving down to the 1-hour time frame, which is where I took my entry, you'll notice something interesting again. That same liquidity sweep we saw on the higher time frame also left behind a wick on the 1-hour time frame. And not just that, price also disrespected the last unmitigated bullish fair value gap. And after that, it left behind an overlapping bearish fair value gap. Now, when you combine those together, that gives us a balanced price range. And that right there was my entry zone. So execution was simple. Entry at the balanced price range, stop loss just at the swing high, target a 1 to 2 risk to reward. Now let's play price forward and see how this trade played out. As you can see, price tapped into the balanced price range, and almost immediately it pushed straight to take profit. So this was a clean win. And if you notice, there was nothing special about this setup. Same concepts, same confirmations. The only difference is that this time it played out. And that's the reality of trading. Now let's move on to the 5th trade of the month and break that one down as well. This one was on NZDUSD. Starting from the 4-hour time frame, the first thing we noticed was that price disrespected the last bearish fair value gap. And after that, price went on to create a bullish fair value gap, which tells us something important. Momentum is shifting to the upside. So now the expectation becomes clear. Price should move from internal range liquidity to external range liquidity. And after taking that external range, we also expect price to potentially reach the high sitting above. So overall, direction was very clear. We were looking for bullish continuation. Now moving to the 1-hour time frame, we noticed something else. The 4-hour fair value gap aligns perfectly with a 1-hour fair value gap in this area. And that alignment is important because it increases the probability that this zone will hold. Now moving down to the 5-minute time frame, which is where I took my entry, the first thing we saw was a liquidity sweep. And after that sweep, price created a bullish fair value gap. And that's where I took my entry. Now for risk management, entry inside the fair value gap, stop loss just below the structure with a slight buffer of about 5 pips. Target a 1 to 2 risk to reward. Now let's play price forward and see how this trade played out. As you can see, price started moving in our direction. It took a bit more time, but it continued pushing higher, and it actually came very close to our take profit. But then, price reversed and came back to hit our stop loss. So this trade ended in a loss. And this is another important lesson. Sometimes price will get very close to your target, but still reverse. That doesn't mean your analysis was wrong. It simply means the move didn't fully complete. And again, this is part of the probabilities. Now let's move on to the 6th trade of the month and break that one down. All right, so now this is the 6th trade I took for the month of April. And this is where we're going to stop for this video, so it doesn't get too long. Now, starting from the daily time frame, the first thing that stood out to me was that price was reacting from a daily internal range liquidity. And once price reacts from internal range liquidity, the next expectation is simple. Price should move towards external range liquidity. So based on that alone, I already had a bullish bias for the day. Now moving down to the 1-hour time frame, we can clearly see bullish order flow. And this is what I mean. Price has been consistently respecting bullish fair value gaps. You can see it here. Price taps into the first one and pushes up. And now, we are currently sitting at another bullish fair value gap. So the expectation becomes clear. This fair value gap should hold and push price higher. Now, because this is happening on the 1-hour time frame, we drop down to the 5-minute time frame for our entry. Now on the 5-minute, the first thing I noticed was a liquidity sweep. Price tapped into the fair value gap, took liquidity, and then pushed up, leaving behind a bullish fair value gap. And that right there was my entry model. So execution was simple. Entry inside the fair value gap, stop loss below the swing low, with a small buffer of about 5 pips. Target a 1 to 2 risk to reward. Now let's play price forward and see how this one played out. As you can see, price tapped us in, pushed up, came very close to take profit the first time, then pulled back, almost to break even, and eventually continued higher and hit our take profit. So this trade ended as a win. Now this is important because this is the reality of trading. It's not always clean. It's not always perfect. Sometimes price will move in your favor, pull back, and then continue again. And sometimes you'll win, and sometimes you'll lose. But the key is this: you are doing the same thing over and over again. And over time, that consistency is what makes you profitable. So don't focus on individual trades. Focus on your execution. Focus on your process. And also, everything I talked about in this video is fully explained in my Smart Money Secrets ebook. You can get it from the first link in the description. If this video was impactful for you, make sure you give it a thumbs up. And if you want more breakdowns like this, make sure you subscribe. I'll see you guys in the next video.